Happy Thursday out there, Team 42. It's your skipper here, Darius to present our macro minute for Thursday, January 2nd, 2025. Hope everyone enjoyed the holiday season. Just want to welcome you guys to a fantastic new year. Let's get after it. So, as always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is, where is consensus heading into 2025? Our answers are: Bloomberg performed a detailed study of 700 research reports from 50 Wall Street institutions and identified several pockets of consensus among investors. The most notable are: number one, U.S. exceptionalism will likely persist across economies and asset markets, thanks in part to tax cuts and deregulation. Number two, higher for longer in the U.S. will contribute to U.S. dollar strength alongside tariffs, which are generally expected to be mild and relatively targeted. And number three, inflation will be range bound and remain above target in the U.S. and other major economies, leading to a carry year in fixed income that favors all-in yields of credit over treasuries and cash. Reminder, these are the same Wall Street institutions whose median forecast called for the S&P 500 to rally only 2% to 4850 in 2024 from their December 2023 forecast. The high in that survey was a rally of 9% to 5200. Juxtapose that with the S&P 500's 23% return in 2024, and me saying this is the most bullish I have ever been in my career in December of 2023. And you can see why many of their top clients on the institutional asset management front have also partnered with 42 Macro. Transitioning to our 42 Macro dashboard here, as always, we'll wrap up with the question from our community. This one's titled, why do markets look and feel so bad right now? Hello, Skipper. Things don't seem so risk on right now. Is this just an end-of-year liquidity vacuum exacerbated by tax loss harvesting and end-of-year profit taking? Do you anticipate a recovery in January? Regards. Love this question. Phenomenal question, because it allows us to, sort of help our client base, and obviously anyone listening to this, graduate up the sort of a sophistication curve, in my opinion, because there's a lot that sort of unpack with respect to the question. I don't mean to be pejorative to the client about the question, but I love the question because it's obviously coming from a good place, and it allows us to help investors grow. So let's start with the word feel. Feel is not a signal. Feel is how you feel. It's an emotional response to what you're looking at on the screen, which is more than likely just price information. And so I would caution every investor to try to remove the word feel and the feelings that you feel as far away from your investment process as possible. That's step number one. So continuing on with this question, things don't seem so risk on right now. Seem, again, this is more just a derivative of feel. Seem is not a signal. Seem is more noise. See, what you feel and how things seem may or may not, reflect the underlying reality, right? We're still in a risk on market regime. And just because markets have, kind of had a little bit of a pullback in December, doesn't necessarily mean you're out of the risk on market regime. What would cause you to get out of the risk on market regime is a preponderance of markets, transitioning from the perspective of their own independent volatility adjusted momentum signals into a condition that supported a higher probability outcome with respect to either the risk off inflation market regime or risk off deflation market regime. So, when you're thinking about, looking at and responding to asset markets, it's very important that you have, systematic guidelines for what you think is bullish or bearish. Don't just say things feel or seem bullish or feel or seem bearish. You're never going to, never going to maximize your potential as an investor if you're approaching asset markets through the lens of seems like and feel. You want to be approaching asset markets through the lens of this threshold was crossed quantitatively or that threshold was crossed quantitatively, because that is where signal is created. The rest of it is just, amorphous noise that can cause you to make some bad decisions in your portfolio. Keeping on with this question, is this just an end of the year liquidity vacuum exacerbated by tax loss harvesting and the end of year profit taking? So the answer is yes and yes, but the reality is you don't need to assign a specific reason for short-term price momentum, short-term movements in asset markets. All you need to do is accept the fact that there are currently more buyers than sellers on any down day or down week or even down month in asset markets. There's more sellers than buyers, and the sellers are more motivated than the buyers are because they want to, they're willing to exit, to transact at lower prices than the buyers are. And so that's all it really meant. That's the fundamental thing, is it's supply and demand of the change, the supply and demand of the asset. That's what's causing the asset price to change. It's not tax loss harvesting or end of year liquidity vacuum. Those things contribute to the supply and demand, but what's ultimately causing the price to change is the change in supply and demand. So, you want to get back to the first principles and then move on from there. And so the first principle, moving on from the first principles of supply and demand, is more sellers than buyers and more motivated. The sellers are more motivated than the buyers. What is causing them to be more motivated than the buyers, specifically with respect to December, respectively, are obviously there are some tax loss harvesting, but we saw, SBF 100 was up a lot in December. So it's not like tax loss harvesting was a function of that. But there was also a little bit of a liquidity vacuum as well. We saw some TGA build as well. We saw some RRP build as well. Global liquidity continues to meander lower. So there's some reasons for that from a fundamental standpoint. And then lastly, do you anticipate a recovery in January? My answer is yeah, but that doesn't make a difference. What I think fundamentally, as you should know it by now as a 42 macro client, has no bearing on how we're going to position in asset markets. If our KISS or Dr. Mo signals transition to being bearish tomorrow, whether Darius Dale fundamentally anticipates a recovery in January doesn't matter. You guys have to get out of your disassociate your desire for this sort of perfect picturesque expectation of where asset markets are headed based on this perfect picturesque forecast of where the economy and policy and liquidity are likely headed, and start accepting the fact that there's a lot more uncertainty with respect to where we're headed from an economic and policy standpoint. You also need to accept the fact that, look, the markets can price in whatever they want on that full distribution of probable economic and policy outcomes whenever they want to, right? It's never all bullish or ever all bearish. Markets have a hard time focusing on the whole distribution at once. Markets tend to focus on the right tail of the distribution, and then at some point they start focusing on the left tail of the distribution, and then they focus on left tail distribution too much, and then the Fed comes in and forces shorts to go by the wayside, and then they start focusing on the right tail of the distribution again. That's what markets do. But the reality is that 100% of that time, while markets are either pricing in the right tail risk or the left tail risk, is there was the full distribution of probable outcomes. It just so happens that the market can only focus on one thing at a time. The market is very hyper-focused. And so it's our job as investors to build, credible, defensible, and ultimately accurate, processes to take advantage of when is the market going to shift its focus from one part of the distribution to the next part of the distribution. And what we do differently at 42 Macro than most every other firm that I see is we are constantly doing research on the full distribution of probable economic outcomes. Again, we are constantly doing research on the full distribution of probable economic outcomes. That is very different than what most people who sit in the seats like I sit in do. What they're doing is, I'm bullish, so here's a bunch of charts for why you should believe in the bullish bull case. Or I'm bearish, here's a bunch of charts for why you should believe in the bear case. You're never going to see that kind of research from 42 Macro. That's just not what we do here. What we do is research that supports our clients' understanding and of the evolving full distribution of probable outcomes. And then our risk management overlay, i.e. KISS or Dr. Mo, tells us that the market is now going to go from pricing in the right tail risk to the left tail risk on this date. So you, the client, needs to do this, and this differently in your portfolio now to stay on the right side of market risk. That's what 42 Macro does. We're not here to say, okay, I'm bullish and I think the markets are going to be up in January, or I think there's going to be a sell-off in the last 2 weeks of December. That's nonsense. You're not going to retire on time and comfortably if that's what you're trying to do. So if you want to retire on time and comfortably as an investor, you need to start investing like the world's best investors, which is what we're providing to our clients here at 42 Macro. So wrap it up there. Darius Dale presenting our macro minute for January 2nd, 2025. 2025. Wow. What a weird year to say out loud. Makes me feel really, really old. Everyone have a wonderful day. I will catch you back here tomorrow. And clients, we'll have our January 2025 macro scouting report on your inbox tomorrow afternoon. So if you, person listening to this, and are not subscribed to our macro scouting report, if you want to see what the full distribution of probable economic outcomes looks like from a fundamental research standpoint, high quality fundamental research standpoint, we highly recommend you take advantage of the research that we're putting out in the form of our macro scouting reports every month. And then obviously, you can access our systematic overlays, KISS and Dr. Mo, every day or every week in between those reports to identify exactly when all caps WHEN, when are asset markets transitioning from pricing in one side of distribution to the next side of the distribution? That's what Kiss and Dr. Mo do. But our fundamental research process is separate from that. So that's going to be out this afternoon, or sorry, tomorrow afternoon. And everyone have a great day. We'll catch you back here tomorrow. Cheers.